Welcome back, everyone, to another Kingscrowd Investment Roundtable. This is your weekly dose of startup investing and online private market investing insights and hot takes with the Kingscrowd team. My name's Brian. I'm Vice President of Product. So we have a few topics we're going to be covering today on both the kind of current news front as well as some data and a deal that we're going to discuss. So on the deal front, we're going to be talking about Helio, which is a precision agriculture drone company that is coming to market and currently has a raise on Start Engine. So Leah will be going over the deal and our assessment of that. We're going to be turning things over to Teddy as well today to talk about some real estate deals. Now, investment crowdfunding can be used for operating companies, for real estate, even for things like racehorses and songs. So Teddy's been taking a look at some of the data around real estate just to give us some insights around some of the activity there. And I'll be discussing with Scott in terms of tax season. So it is coming up on April 15th. We're only about a month away now. What that means for, unfortunately, a lot of startup investors are K1s, which is a form that you may receive if you invest in LLCs. Scott and I will go over all of the different key takeaways in terms of just things to be aware of, not tax, not investment advice, but from our own personal experiences. All right, well, let's hop into the first segment today. I'm going to be joined by Scott Katoon, and we're going to talk about something that many investors probably don't even think about. Many investors probably don't like thinking about it, but that is taxes. It's something that is required, when you're making investments. Obviously, I think a lot of people are familiar with short-term capital gains, long-term capital gains. What we're going to be talking about are some of the more tax-specific situations when investing in startups and alts. So March 15th is coming up here. Why is that date important? March 15th is technically the date when your K1s, Schedule K1 is a filing partnership, basically tax filing form, that as a company, you have to provide that to all of your investors, your LPs. Now, it's typically only something that an LLC company is going to send to you. And what most startups will end up doing is filing a tax extension. So if you're going to get this at all, you might not get it until the September-October timeframe. Now, myself, I get probably, if I look through my AngelList investments, through some of my Reg CF investments, I probably have 15 to 20 Schedule K1s that I am entering personally on my TurboTax each year. I do my own taxes. However, I want to talk to Scott here, shaking his head. Scott also has really good from the co-founder perspective, but what are you thinking about this time of year, Scott, in terms of tax considerations?
Avoiding phone calls from my accountant. No, I mean, if I'm being totally honest, I can tell you exactly what I'm thinking. I file an extension every single year. I have not done my taxes the year of probably for like 6 years, 5 years. So I just naturally, there's just a lot of shit that's moving, and I don't know necessarily, I'm not the best tracker of this stuff. So I have an accountant, we get on, Tax Caddy, I upload all the docs. My wife has a standard, what do they call it on Twitter? A based. She's basic. She's based. She's a base life. So it's just like a, teacher salary and some daycare stuff that we write off. I have to reconcile everything. So I usually just punt it to the end of the, to October.
Yeah. I'm same way. I don't think I've, now granted, reminder to everyone, this is not financial tax advice.
Yeah.
Obviously, we are not
Go talk to your accountant. I don't know what I'm doing.
Please talk to your accountants. But another thing to remember is just because you file a tax extension, which I have also done for probably the past 4 or 5 years, you still have to pay your taxes by the April 15th tax deadline. So do not forget that. Now, that being said, I think that taxes and things like K1s are not something that some of these people who are investing in, startups on some of these platforms like WeFunder and Republic and Start Engine are thinking about. I will say that for most of those platforms now, they've figured out ways where even if it's an LLC, you're probably not going to get a K1 from them in most instances. There's a few outliers, but usually there's other ways around that. But if you're making investments on platforms like AngelList, if you're making investments into funds, potentially things like that, those are the situations where you may get a K1, and it's at least something to be aware of.
I would imagine most people listening know what that is, but do you want to like just quickly run through like what a K1 is, why you're getting it, like relative to
Yes.
the new investor?
Thank you. Great question. Because honestly, it's something even that, each year I go back and kind of refresh myself. So for companies that are LLCs that are taxed as partnerships, those are flow through, pass through entities. So that means that any of the taxes, whereas it's different than a C corporation, it's taxed at the corporate level. With an LLC, the taxes, any gains or losses are passed through to all of the partners in that partnership. So what that means is that if a business, a startup, has had taxable event, whether they have income or losses, expenses to write off, those have to get passed through to investors. Now, a lot of people will say, "Oh, well, startups, you're not really getting, they're not making a profit or anything for the first few years. There's usually not paying dividends or anything like that. So why would I get anything?" Oftentimes you're still going to get, just because of the way that they do some of the accounting. And honestly, half of my K1s are in the amounts of like $10, like $5, like minus $4. It's honestly a little bit annoying, right? Because a lot of these numbers are so small and it's like I have to take time to do this on my taxes. But depending, that is commensurate with the size of your investment. So if you have larger investments, and obviously if some of those investments have bigger events that occur, you could have amounts that materially impact your taxes, which is why you get that. Do you have anything to add to that, Scott, based on your experience? And
No, I mean, this is the only thing I'll say is like after going through this is why you find certain investors who like avoid types of investments. Like in particular, when we were like for Songfinch, we ran that company as an LLC. When we got to our seed round and we had our first like real true price, they wanted us to convert to a corp then. So we inked then and had to convert everybody over. And it was a huge pain in the ass for everyone involved because we had an SPV that was is on the cap table, and there was the original co that we turned into a new co. And so it basically got like new code in 12 months and then recode in 12 months. It was stupid. But it's just one of those things that like, depending on what type of investment framework you're set up on and when you got involved in the business, your qualifications for QSBS, your qualifications for writing it off, and like this, to your point, like a company that doesn't have many material events may lead to minor taxation issues. But then what if it does, and you're caught in the middle of that? Like it's just something that certain investors are what we like to call value investors in a friendly term. They're looking for every reasonable way to take advantage of this. They know that it is a high risk investment to begin with. And so if there is anything that they can extract on the risk side as value, they do. And usually these investors are the most annoying people on your cap table, but they are necessary at times. But for real, like it matters. And so I think a lot of investors have decided, if you can get in an ink earlier, that's great. It's also one of the reasons I think, to your point, why people do like the fund structure is it consolidates a lot of your stuff. But that's a different topic.
Yeah. So QSBS, just to touch on one of the terms you've mentioned, and we talk about, somewhat often here around this time, qualified small business stock. That's not just something for venture capitalists. So even as a small investor who's writing $100, $500 investment, $1,000 check, if the company qualifies and meets those QSBS standards, where there's kind of a checklist of different things, you have to have a minimum holding period of at least 5 years. If you can meet all those criteria, C corporation being one of those, it can't be an LLC, you can get 100% tax-free gains. So that is way better than long-term capital gains, right? So I think it's also important for investors to be aware of that, because I think a lot of times they don't even think, it's long-term capital gains, short-term gains, you're writing it off, but there is this special provision as well that can be available.
And that's a major key for founders. And I can't remember the specifics on this. So again, the advisory of not an accountant here. And I'm about to prove that very clearly. When Songfinch, we had the LLC and we converted into Inc., their accounting actually believed that, like, as founders of that business, we did still qualify for QSBS for the 5-year hold, given that the business existed before as an LLC and then converted. I do not know how that was the case, but they did deem it that it qualified. And it ends up being, as a founder, it's like one of the main reasons that you do this is that you have the potential to invest your time. And I know a lot is said about the dilution that takes place when raising venture. And obviously, again, that's a different topic, different show. It's true. The amount of dilution that a founder will incur if they raise a bunch of money is significant. One of the reasons you get away with it as a founder is like, if I have QSBS and I'm in this business for 5 years and I'm not paying capital gains and I end up having an event at like, $10 million, like I'm sure if I hadn't raised, I probably wouldn't, have given up so much equity, but I probably wouldn't have gotten a check for this amount because I don't pay taxes and capital gains. It's like, so, and of course, there's also other sides of this. Like if you're writing off losses on the business, you do, and you use those on your personal taxes, you do have to end up kind of paying that back in one way or another. So like, there's just a lot of stuff that gets involved here. And I think all of it is really fascinating, and glad there's guys like you who can talk to this to our investors. But it is kind of a funny side thing as a founder where you're like, we say this and we're all talking about this, and at the end of the day, kind of all that shit goes out the window and you're just trying to like hold on to your hat, So it's like, there's just so many, like, I wish that and other founders would like have enough success in the first event that we did, that when we did startups together next time, you come into it very organized and like tax deferred, and you're just very smart about it. It just ends up never being that way. It always ends up being like a complete chaotic mess. And when there's an exit, everyone's kind of looking around the table like, did I qualify? Did I make it? And then if you didn't, you're like, what are you going to do? Like you made a shit ton of money. So like, let's go home.
And a lot of times the burden of that is not on the company at that point either. It's on
Right.
the investor. So you need to prove, was that company QSBS at the time you invested? And so sometimes that's where having good documentation, if you're keeping your subscription docs, even taking down and creating a checklist of some of the items to make sure it's meeting it. So I'm curious, how do you track some of your tax stuff? Do you just use a spreadsheet or?
No. So my accounting firm has an app called Tax Caddy.
Okay.
Yep. And literally I can just plug everything into that. And so like my wife plugs it, sends it to me, and I put in all her stuff, and I have my stuff. I do have like an Excel sheet for like I said, the majority of investments that I've made individually that are of a size. And then like from a write-off investments, like I did a lot of card investing in a period of time. Like I have that kind of stuff, like what I paid and what I sold or whatever, what I lost, and kind of keep it. But like, I wish I could say it was strategic that I like extend the taxes. It really is a mad dash. Like it all comes in and I'm like, fuck, I don't want to do all this. So then I end up just kicking the can a little bit, and then I kind of reconcile and send the mess to them and pay them $2,000 bill to clean up my mess every single year.
Yeah. I think what you mentioned though, which is a little bit of what I was getting at, is not, even if whether you do your own taxes, if you use, H&R Block or TurboTax, or if you have a CPA, if you're working with another thing, as an investor, they're still going to need that info of like, did any of your companies go out of business last year?
Right.
Or did you have an exit? So you got to keep track of that somewhere. I will say, so one of the features that we've built out for Kingscrowd that is a free feature right now, if you go to the portfolio tool, you can add your investments, which is great because you're tracking all your stuff in one place. But we actually have a tax center. And what the tax center does is it links up to our database of companies that have had successful exits or failures, and it allows you to basically see over the course of a certain tax year, did any of your companies go out of business? So the way to access that from the Kingscrowd website, create a free account, then head over to your portfolio page. You'll see this is just a sample portfolio here. If you have investments added, it will give you actually a reminder around this time of year where you need to visit the tax center to review potential exits. So you can see we have 9 sample companies that are entered here. If I click on the tax center, what it's going to do is it takes those companies and it compares it against our database of over 500 exits and failures. And it actually says, oh, look, there's been 2 confirmed exits and failures. Now, both of these in my sample portfolio, we have already entered in kind of an estimated realized value. If this was your first time ever going into the tax center, it would show you that you need to review both of those 2 transactions, which is basically a way of just confirming it. And then it gives you a summary by year. So if I take a look at, these 2 here, for example, this company had an IPO. The exit date was back in 2023, or actually, I think the IPO might have even been before that. This other one shut down. So both of these will show you, for example, you can put in your gains, your losses. Yep. And it calculates it. Now, again, this is not meant to be like an official doc to be able to file your taxes with, but it's a tool to be able to help you as an investor keep track of your stuff. So, personally, I think I have 230 companies in my portfolio, and trying to keep track of which ones of those went out of business over the course of a year, which ones exited. I sometimes find that out third party, like, through other investors, that certain of my companies have gone out of business, not from the company themselves. So whenever Kingscrowd gets that, we add that here and try to make it easier for investors. So
it's a great tool.
And we have a lot more we're actually going to be adding to portfolio and even to this. So one of the other things we mentioned, right, is it might be helpful to know which of the companies I've invested in are LLCs. So that's actually one of the features we're going to do. And then you can just, download that right to a CSV and take a look at it from your computer. So, and you can see here.
That's awesome.
Yep. All right. Anything else to say in terms of taxes, Scott?
Not a whole lot. I mean, I think the lesson to take away here is, one, that Kingscrowd tool you showed is a great starting point to learn and figure out how to do this, and that I myself should be more organized and maybe pay a little less to my accountant. I think it's even easier for guys like you and I who've been doing this for a while. Like, for new investors, you think of equity crowdfunding and things like that. If that's your only exposure to this, I'm going to guess that they're not really thinking about K1s and taxes and taxation and exit and liquidity events and that, and like, they're all hoping that they, catch one and it's a big payoff, but like, they potentially set themselves up for a bit of a trick bag if they don't pay attention early.
Yeah. And even just failures, right? When a company goes out of business, you need to make sure you are reporting that on your taxes, because that can be a write-off.
I was just going to say that's the one thing that we didn't get to, is like, maybe investing in startups is a good idea for write-offs.
So I've had several years. I actually just went through my portfolio. I'm happy to share this. So out of 230 investments, I've had 24 exits to date that were mergers, acquisitions, IPOs, and 34 failures. Now that sounds like a scary number, 34, but if you do the math,
it's
like
insane.
A 16%.
You're like the best
rate.
Investor in the whole business, is what that looks like.
And I'm definitely not. That is not the case. But I think, these failure rates are actually somewhat in line with the industry right now. Yeah. And there's going to be more in the future, and some that we don't know about. But key takeaway is that's 34 investments where I can basically write that off. And that comes off either against short-term, long-term capital gains. And then depending on the type of business, and again, this is where you want to talk to your accountant, there are some other potential benefits if it qualifies as small business, a special type of small business stock under the Internal Revenue Code. You can actually write it off against ordinary income as well, which is, a higher tax bracket for a lot of people. So again, do some research on this. We actually have some great content as well on Kingscrowd. We have some tax articles. So if you head over there and just Google, tax or like Section 1202 or QSBS, those articles will come up and pop up for you.
Brian, I have one last question for you. When you showed the example, I saw that you invested $10 into Stripe. Stripe, to my knowledge, is not one of our crowdfunded companies. Are other people able to write businesses that they've invested in that are not part of the crowdfunding portion, and actually, like, are we pulling in data in case the company that went public that isn't crowdfunded? Like, would we know that if the Collison brothers decided to finally bring that puppy to the masses?
Great question. So,
which, by the way, they're not going to do. They said in a recent interview they're not. Just not investment advice.
So today, the ones that you see here, for example, that aren't linked to anything, those are custom added assets. So anything that's underlined is linked to our database. You can click on the company. It brings you to their Reg CF or the Reg A filing. Those are, an equity or debt crowdfunding offering online. You can add, we call them off-platform investments, but you could Stripe, or if you wanted to put other alts in there, Bitcoin or some of your collectibles cards, you can track those. We don't have that synced up necessarily today to say link that for if there's a future event, but
it's possible
set up in the future where we could add those features to the portfolio. So then you start getting more updates even about some of your platform, off-platform or more private investments as well.
Do you hear that, Kingscrowd members? Just send an email to Brian. We're going to get this. We're going to push on you and get that thing done sooner rather than later. I appreciate it. That's really a great tool.
No, appreciate it. And we've heard lots of feedback. People want some more features with their portfolio, also showing, estimated value based on companies have gone out of business, and we know the more recent price per share. So those are all features we're looking at over the next few months.
Amazing.
Awesome. We'll wrap things up there for this segment. Thanks for joining us, Scott.
Thank you.
All right. In the next segment, we're going to welcome Teddy here to introduce some of the data that he's been looking at for real estate deals. Teddy, I'll hand things over to you, but why don't you tell us a little bit about some of the data you've been looking at?
Yeah, so what I really wanted to get a handle on with this chart of the week was looking at real estate deals in the equity crowdfunding space. And by that, I mean actual physical real estate deals you can invest in. So, there are a lot of opportunities that we see that, investors can make an investment into a fund or an SPV or whatever it may be. And those funds will then be used to acquire or develop a multifamily real estate kind of area in whatever state. And then the way investors actually get returns on that is through rent, physical asset appreciation, kind of a more traditional real estate investment, and not so much including kind of fractionalized real estate platforms or things like Ground Floor, Elevate, where you can buy like little pieces of different real estate all over the place. Those are kind of platforms. Those we do rate and are more software companies, and you analyze those more so in like how are they gonna acquire customers, how much does it cost to like get people on the platform, they pay subscription fees. This analysis wanted to focus more on kind of the hard real estate opportunities where your money's actually going into building or renovating an actual piece of real estate. Okay, so here is the yearly. So essentially what I first did is I pulled all the real estate and construction deals in our system. A lot of those included platforms like Ground Floor, Elevate. So I kind of did a data scrub to pull out actual investment opportunities that are strictly for investing in physical real estate assets. So these are the aggregate funding amounts for all of these deals on a year by year basis. And you can see kind of 2016 was kind of the beginning of equity crowdfunding, kind of no real estate deals at that time. And kind of as both equity crowdfunding got more popular, there became more and more physical real estate investment opportunities on a lot of these different platforms. So you kind of see a steady increase over the years with physical real estate deals and the aggregate investment volumes here. And then you kind of see a big drop in 2023 and then a kind of shoot back up in 2024. So kind of part of what I was asking myself is why might this be, and talking with some colleagues about it. And something that came up was kind of looking how the interest rates, the federal funds rate, may have affected investment volumes. Because we know, generally speaking, when interest rates go up, borrowing becomes more expensive. So therefore, real estate investment generally goes down. So we kind of want to see that inverse relationship. So what I did is I basically took an average annualized federal funds rate over each of these years and kind of layered it on top. Again, these are kind of V1s of these charts, kind of, when we actually release these, it'll be in this nice Kingscrowd format, but kind of wanted to give a little bit of insight into kind of how we do some of our data analysis here, especially when looking at how macroeconomic trends may affect it. So this line that I don't know what color it is because I'm colorblind, that is just kind of turned this into a line graph. This is physical real estate investment volumes every year. And layered on top of that is the federal funds rate. And so you can see like the inverse relationship. You see it at certain times, kind of in this small area, kind of in this small area. So it's not a perfect alignment, which can have many different reasons. But what I wanted to look at next was, okay, now that we have these two sets of data, federal funds rate and aggregate investment volumes over the year in equity crowdfunding real estate, kind of, is there a statistically significant relationship there? So bear with me on kind of getting into the weeds here on data, but so did some quick regression analysis work kind of on that first graph and those first two sets of data. And we can see that, yeah, the p-value is very high. Like we want this to be under 0.1, and 0 is included in the upper and lower bounds here, which basically just means the relationship between these two variables, the federal funds rate and the aggregate investment volumes year by year, are not statistically significantly related. So kind of thinking about next, like why that might be, is a lot of these macroeconomic indicators are lagging. So it takes a little bit longer for the market to actually react to them. So the second analysis I did was I lagged the federal funds rate by a year. So point being, it's at initial look at this data would show that the relationship between federal funds rate and investment in real estate deals on equity crowdfunding is a bit more nuanced than just that direct inversely linear relationship. So data analysis is very obviously complex. There's a lot of factors that go into it. And I think sort of the next step in Kingscrowd and the data analysis it provides is getting a bit more kind of the econometrics involved and kind of seeing the statistical relationship between a lot of these variables. Is it significant? Are there omitted variables that you could add to make it more accurate? So anyway, just wanted to give a little window into some of the data analysis work that we do for some of these charts of the week, kind of beyond this initial chart, which is probably what we'll release, just kind of general aggregate numbers over the years.
One quick takeaway for me is, I mean, from the first chart that you showed, right, the number of real estate deals are increasing over time. So I think real estate is utilizing Reg CF more and more. So there was this secondary question of, was the dip in 2023 maybe due to the fact that interest rates were going up? But it could be, right, as just your point where there's other variables in there that are impacting this. Maybe if interest rates increased and it drove deals away from the more traditional channels through like private syndicates and onto platforms, it could actually go up, right? Like there's all these kind of conflicting ways and different really complex kind of interactions between the variables. So my takeaway here is if you kind of just look 2019 through 24 with more of like a linear trend line, the number of deals is definitely going up. And so if we extrapolate that out, we're probably going to continue to see more and more Reg CF being utilized by real estate. Now, of course, and Teddy, feel free to remind me, did you include Reg A in this analysis or was this just Reg CF?
This was just Reg CF.
Okay. And that's a good point because Reg A is very popular actually for real estate, but that's something that Kingscrowd does not today track, which is actual real estate offerings on Reg A deals. So for those of you who are real estate investors out there, you may have invested on platforms like Ground Floor, like Fundrise and different things like that. A lot of those utilize Reg A, but we're not tracking those as part of the data because we basically have 100% Reg CF coverage. And then we look at operating companies who are raising under Reg A on major platforms, for example, like on Start Engine, on Dealmaker. But the ones that are on real estate platforms, we're not tracking those yet today. So that's just another part to be aware of, I think, in this analysis. Well, thank you, Teddy. Let's move on to our deal of the week that we want to talk about. So Leia has been looking at a company called Helio, currently raising on Start Engine. Leia, why don't you tell us a little bit about this company and kind of what caught your eye and made it a potentially interesting opportunity?
Yeah, Helio is actually one of the only US manufacturer of spray drones. So spray drones are larger drone than the one you may see on a daily basis, kind of the play drones. And they are actually able to spray maybe, herbicide or fertilizer, and they're used by farmers to help them reach the crops without having to use a tractor. The problem with tractors is that they will actually drive over crops and may destroy a part of the plantation, which is definitely not what farmers are looking for. The advantage of drone is that they can target very precisely the zones that needs to be targeted by, let's say, the herbicide. Let's take a quick example. If you have a fungus that is kind of starting to destroy a very specific part of a plantation, a drone will be able to very precisely target this zone without having to spray a potentially harmful but yet useful pesticide over the entire crop. You can really just delimit it. You can really just spray it only on one specific zone. And what makes Helio better than competitor is that it is US made. So we know that a lot of farmers are really sensitive to this, even if its price, about $65,000 per drone, is more expensive than any other Chinese competitor. They go from a couple $1,000s to up to $50K. But Helio is really emphasizing on the fact that, according to them, they are a higher quality product that will last longer in time. And we also know that with the current geopolitical events, Helio could actually become potentially cost competitive if tariff impact the Chinese-made drones.
Yeah, so pulling up the deal page here, I think a couple important things that I noticed. So this is actually Helio's second online funding round, if I'm not mistaken. So they did a round back in 2022 that closed on Start Engine at a 35 million valuation. Now, looking at the current round, they do have quite substantial revenues, 11.5 million, and profitable with decent cash on hand. But I'm curious, when you look at the current pre-money valuation of 150 million, both of you, what do you think? What's going through your mind in terms of, is this a good potential investment opportunity or not at that valuation?
I remember that when we discussed this internally, kind of everybody noted that the valuation is way higher than what we will usually aim for. Even if it's high, I think it's mitigated by a couple of factors. The first one, as we say, Helio generated a revenue of 11.5 million in 2024. But the good news is that it actually maxed out its first manufacturing facility. So the revenue could have been way higher than that. It just could not produce enough drones to fulfill all of its orders. That's pretty good problem to have. Right now, as we speak, Helio has about 7.5 million worth of pre-orders that they should be able to deliver by Q2 2025. And they are building a new manufacturing facility that will expand the production capacity this year. So we believe that Helio will drastically be able to keep increasing its production. We see that there's true product market fit. There's a demand for this product. Many farmers, whether it's family farms or industrial conglomerates, are moving to the drones instead of the tractor or human spraying systems. And so we think there's a real growth opportunity here. Now, obviously, it kind of depends on an investor. What is your exit target? Do you want to have, I don't know, 2, 3, 4, 5x, or are you reaching for a 10, 15x? If it's the later, Helio will have to be worth probably around somewhere $2-3 billion for you to get that type of return. It is not impossible, knowing that Helio is one of the only company in the United States manufacturing on this soil. It will take couple of years and a lot of capital for any competitor to try to reach the point at which they are right now. If they keep growing, if the market keeps growing, and if the adoption of drones keeps growing as well, there's a real chance that Helio will be able to reach that valuation. Now, obviously, this is risky. This is one of these risky deals where you need to go for a unicorn. I believe that Helio has assets, profit, product market fit that make it well positioned compared to earlier stage company to maybe reach for that deal, but it's definitely a risky bet here.
Teddy, I know you're usually looking at things like financials, margins, how they're going to expand their manufacturing capacity. Do you have any thoughts just in terms of the type of business model and the business this is, how they stack up?
Yeah, I mean, with hardware plays like this, something that requires very expensive manufacturing facilities, a lot of capital expenditure, OpEx, those types of things. Seeing higher valuations isn't necessarily too surprising. 150 is definitely, I think it was about 150, definitely very high. But again, as Leia was saying, the product market fit is there, and it's more of a question of building out the manufacturing capacity to keep up with the demand it has. And that's how it's really going to skyrocket revenues. So they definitely baked that into that $150 million valuation. And second of all, what I really liked about this company is the competitive landscape. There are a lot of Chinese-based companies making drones for a variety of different use cases, but specifically in the House of Representatives, there was, I think it was the National Defense Authorization Act, where this was in December of 2024, where they're actually limiting the sales of DJI drones, which is like the biggest Chinese drone company. So that value prop of being US made, I think, is even more valuable in the current kind of climate of the next 4 years or even beyond. Drones having a lot of military use case, spying use cases, and I think kind of the Chinese made drones will be subject to like more and more regulation, making American made drones more kind of companies that make them in the United States more valuable. So that's what kind of sent it over the edge for me in really liking this company, and clearly they're doing amazing. So it's always good to see.
Yeah, to that point, a company that raised a past crowdfunding round, they actually sold it out. I believe it was 1.07 million. They had I think they had a couple million in revenue at the time, but they've grown it right to 11.5. So they're actually showing that with investments, they can execute. And to Leia's point, if they can expand manufacturing capacity, they can fulfill all these other millions in orders. So looking pretty promising from a product market fit perspective, and also from a moat, right? You think of what's their defensibility. That's something that we always look at. And the fact that it is a hardware company, right? That automatically a lot of people just want to go into a software SaaS business and not think about the real world. And then FAA, right? There's regulations and other things, licenses they have to comply with. So there is a lot more to get over for any other people who would try and come in to upset them potentially. So if they get a good enough lead in this market and can really start converting farmers to use more drones rather than tractors, potentially have pretty good staying power.
Talking about the FAA, regulation are pretty much in their favor. So right now, most spray drones need to be operated by 2 human beings. So we're talking about 2 humans per drone. One who would be the driver, another one who would be the visual observer. As you can imagine, this is very expensive because it costs a lot in terms of overhead. But according to the founder and CEO, Helio is the second United States company that is allowed to have 1 human manage 3 drones. So the way the drones work is that farmers can actually pre-schedule on the software where the drones are going to operate. So you don't technically need to have someone who is kind of playing with it, like you can imagine doing it with your own drone at home. So you're going from 6 humans for 3 drones to only 1 human to 3 drones. That's a huge cost saving, and that's also a big advantage, a big point of defensibility for Helio compared to competition.
That's very interesting. And I'm assuming there's good reasons for 3, but who's to say without a little more R&D and maybe some more parts in the product, people control 4 or 5 or even more drones than that. So pretty interesting from a future scalability perspective. Awesome. Well, this is a deal that does close, I believe, at the end of April. There are going to be a lot of deals closing at the end of April. Everyone should be aware because that is usually when new updated financials are required if you have an open raise. So make sure you check out Helio if you are interested before that time. And with that, we'll wrap things up there for this week. Also, make sure you head over to kingscrowd.com. You can sign up for our free newsletter. You get lots of these great data-driven insights, and you can also check out the deal pages. So like Helio and all the other ones that we have, anyone who's raising online, you can go look at their ratings, see how much capital they've raised, and different analytics about their round. Thank you, everyone, for joining us. We'll see you back here next week.